487.
Yeah, no, the Uber score is, I think, just as valuable as a FICO score these days. Maybe that will be the future of mortgage, where the all-inclusive risk tolerance is how well do you tip? You get the black card, you get the comfort or whatever it is, and what's your process like there? I don't know.
Do any of you know, boy, really starting off the show talking about non-mortgage stuff here, but what difference does it make if I'm 4.9 or 4.8 or 4.5 or whatever to Uber? Will the driver not pick me up if it's too low?
I don't know. You should try it. You should cause a huge racket, Rob, on your way home
Throw
later.
up. I'll throw up
Yeah.
on my next Uber ride.
Yeah. And then kick out a window while you're at it and see what happens.
You might need a burner phone though. I don't know.
Yeah.
Right.
Yeah.
Works for me.
Or just call the Uber under Robbie's account and then see what happens with Robbie.
Because Robbie
Right.
is the winner in this group.
That's what I usually do when I charge things, and then I don't pay for them. I do that under his credit card. In fact, he doesn't have any credit cards left because I do that.
Yeah.
How about those FICO score? How about FICO? How about are we going to talk about Advantage and all of that on this call? Actually, Marcus, you should probably take us away, right?
Yeah. I'll go ahead and kick things off. So, hey everyone, I'm Marcus. I'm going to be moderating today's Capital Markets Wrap. Sponsored by Poly. We're a product and pricing engine company. We've got fun features like mobile lock and AI capabilities with our mobile platform. So today, as you'll notice, we have a new guest on our wrap. We've got Dawn from Plaza. Dawn, I'll let you introduce yourself and we can kick things off since no one's seen you on this thing before.
Thanks, Marcus. Happy to be here today, you guys. So I'm Dawn Michelle. I work at Plaza. I'm EVP of Operations Enterprise Execution. I've been at Plaza for 15 years. My area that I oversee at Plaza is operations, underwriting, wholesale operations, vendor management, project management, IT. So pretty large area. That's about it.
Yeah, very
Wow.
cool.
Then you're in charge of vendor management?
I am.
So did you tell Polly to that you thought it was a good idea for them to have briefs on their exhibition hall desk that people could come get underwear, Polly underwear? Or was that Marcus's idea?
That's a great question. That would be a question for our head of marketing. Yeah, I'm not in charge of the briefs, the Poly briefs. So Rob, Don, and I are all at Western Secondary now. If you guys have any, Don, are there any like quick takeaways you've had so far from just meetings and so on?
I'd say the hot topic that you guys all know is AI. Almost every single meeting that I've had, someone is talking about AI and what's happening in our industry with AI. I mean, I think we're scratching the surface with it for sure. There are various vendors that are already and lenders that are already, adopting it, but it's a long way to go, I think, with it. It'll definitely change our industry for sure.
Yeah. Rob, what about you? What are some of your takeaways from conference so far?
I'm glad that I'm having an entirely different conference experience than Dawn. I try to stay away from the AI conversations too much because I'm old and I don't understand it. I know that when I start typing an email, I get some magic hand fills in the rest of my sentence, which I find confusing, and I turn that off as quickly as possible. But in all seriousness, I think the big, from my perspective, there are two big topics, and I've written about them in my commentary. The first is the fact that the market seems to believe that the Federal Reserve will indeed cut rates by 25 basis points in September. And the unicorns will start prancing on rainbows and the sun will burst through the clouds and suddenly we'll go back to 2020 volumes and do, $4 trillion. That's not the case, as best I can tell. Not that the Fed won't cut rates because at this point, I think it's priced into the market. But if you look at what the Fed does, it does not set mortgage rates. And in fact, I think the last time or two when the Federal Reserve reduced rates, mortgage rates actually went up, right, Ira? I think they went up.
Yes.
And so you're looking at a situation where the Federal Reserve is going to do what the Federal Reserve is going to do, and in theory that'll help small business loans by 25 basis points. And I think the average small business loan is, let's say, $300,000, so that's $40 a month better off. I don't know if that's enough to move the economy per se, but the psychological benefit is there. But in terms of going back to the Federal Reserve, so let's say it cuts rates, and that's pretty much already priced into the bond market, I think. And so we could see rates, 30-year mortgage rates or even 15-year mortgage rates, not do much of anything. And so I hope that for originators who are tuning in, they look at this and they think, all right, if I have a borrower who's on the fence about doing a refi or buying a home or whatever it might be, they should not wait until September to do that because the Federal Reserve is going to cut rates, so I'm going to get a lower rate. That very well may not happen. It's better that they lock in now or refinance now. Uh, I'll shut up here pretty soon. But the second thing that I'm seeing in the conference is this confusion with Fannie Mae and Freddie Mac, and on again, off again. And what does it mean to do? Who heads up Pershing Investors is Bill Ackman. Um, Bill Ackman's uh, goals in life and strategy and so forth probably does not match the typical Fannie Mae or Freddie Mac borrower in terms of their lives. And so the thinking is, A, in fact, as soon as we're done with this call, I think I'm going to go buy stock in Fannie Mae and Freddie Mac because I think we can buy stock in Fannie Mae and Freddie Mac. So it's not, in theory, an IPO. It's not an initial public offering in the way we think about initial public offerings. But the everyone's like, oh, the taxpayer will get money. Well, I don't know if the taxpayer will get a lot of money. I think a good chunk of that will go towards institutional owners of Fannie Mae and Freddie Mac stock, including Mr. Ackman. And I think that's where his goals lay. Um, but it's not what's being talked about with Fannie Mae and Freddie Mac. I'm not hearing any originators say, "Good, good, this is really going to help my borrower." I'm just not hearing that. So I'm going to pass the baton a little bit here to Ira, who deals with originators, or James, you guys who are dealing with originators. Is what's being talked about with Fannie Mae and Freddie Mac, is that a good thing or a bad thing, or is it still too nebulous?
Yeah, I mean, I sort of think it's a little too early to tell the exact how all this is going to fall out. Because I think we also have to separate the entities from, the bond market and what we deal with, right? Like you said, that you could buy the stock. I own a tiny bit. I'm probably finally at break even. Um, so the IPO terminology is a little confusing. But I think more importantly, we have to remember that, a few years ago, and James, you probably have a better idea on the date, the MBS market has the uniform MBS. So, in theory, there's talk about combining Fannie and Freddie and, how this will all play out, but it's something we've sort of already been dealing with on the back end of things. So while we could still sell loans to Fannie, we could still sell loans to Freddie, we really don't know the ultimate impact of the whatever it is, IPO or taking it out of conservatorship, putting in receivership, however you want to phrase it, and how that's going to impact our market in the day to day. Now, it's stock, it's great if you go and did the last 3 days, you made a nice little profit on that. And you sort of have to, put aside a little bit of the noise and the pumping of the stock, so to say. But I think it's still too early to say how it's ultimately going to impact us.
Yeah, I would echo that. I mean, first of all, we can have a whole entire series of podcasts on just this topic. But I think, to Ira's point, when we talk about UMBS and single security, I mean, that was years in the making. And I don't want to undersell how complex it was, but on the surface, all we're talking about, quote unquote, right, is combining Fannie and Freddie securities. And that was a huge undertaking. In this case, we're talking about Fannie and Freddie. There are so many moving parts. And I think the biggest thing I would emphasize is investors need to have an absolute rock solid, ironclad understanding of what the future state of government role in housing is going to be. Whether there's an implicit guarantee or explicit guarantee. Then there's the timeline piece of all this too. The president said he wants to see a secondary offering by the end of the year, and I personally, I just don't see that at all. There are so many questions. What happens to Treasury's senior preferred stock? What level of capital would they need? What's the role of FHFA in the future? It's my understanding that only Congress can alter the charters of Fannie and Freddie, and notwithstanding kind of the regime that we live in right now, this is a really complicated topic that well thought out people on both sides of the aisle have different perspectives on. So at the end of the day, my overall point would be the MBS market is trillions and trillions of dollars deep, and we're talking about foundational, fundamental changes. It takes Congress and Treasury and FHFA, the OCC, the executive branch, right, all being on the exact same page, in addition to the levels of concern with investors, with regulators, with capital requirements, and so on too. So look, I mean, we've certainly seen the administration move quickly and try to push things through as fast as possible. But I guess my last point would be, does that necessarily bring top dollar when there's so much uncertainty with respect to the shares? So I just think it's there's a lot of moving parts to it. It's never say never, don't get me wrong, but at the same time, there's quite a bit that we need to do, and it's a very foundational thing.
It doesn't help when, and I harken back to May. Ira, you were there, I think, and Marcus, you were there. James, I don't know if you were at the national secondary or not, but and Don, I don't know if you were there or not either. But Bill Pulte comes out and says, well, we're going to look at this in 2026 and 2027, and then a couple of days later, Donald Trump tweets, well, this is a high priority. We're going to be looking at this now. And so it's like, all right, what do we do? And then the yin yang Bill Pulte, Donald Trump statements are confusing for the marketplace. And once again, we are dealing with companies, all they're trying to do is help their borrowers. And to have this uncertainty swirling up there isn't, I don't think, conducive to helping them. Now, in the long run, it may be. Ryan asked a little while ago about, well, maybe loan level price adjustments will change. I don't know. It almost seems like, and you guys can correct me if I'm wrong, it almost seems like sometimes the administration or Bill Pulte is trying to de-emphasize Fannie Mae and Freddie Mac's role in our industry. And we've certainly seen a big shift towards non-agency production, non-QM and bond programs and portfolio loans and HELOCs and seconds and so forth. Oh, and that's away from Fannie Mae and Freddie Mac. So their market share is going down. Now, if they want to boost their market share, yeah, they could reduce their G fees, which are in the 70s. That would help because, correct me if I'm wrong, guys, the non-QM investors don't have G fees, right? And so you're dealing with G fees and you're dealing with the agency loan level price adjustments, which can be pretty onerous. And so you have a situation where non-QM, DSCR loans, whatever it might be, some of their rates are actually better than agency rates. Well, if I'm an originator, that's where I'm going to take my borrower. So it's an interesting situation with Fannie Mae and Freddie Mac. If really Fannie Mae and Freddie Mac, i.e. the FHFA, i.e. Bill Pulte, are actually saying, let's scale back their market share and, gradually make them not irrelevant, but just kind of a piece of the more of like a regular, smaller piece of the pie. I don't know. Thoughts?
No, that's great. Thanks, Rob. I was to say, talking to a few investors out in the Western, it definitely seems like there's a lot more investment and product development on the non-QM side, but not necessarily like the alt doc stuff. It's just straight up full doc, just because it is being priced so much better than we're seeing. And I'm seeing a lot of comments in the section that kind of kind of validate that. I don't know if there's anyone else that had thoughts on what Rob, James, and Ira just said, but with that, let's do a quick pivot back to the Western and to Don. I know that Rob, you're not a fan of AI, and Don, you've probably taken more AI meetings in the last, I don't know, 14 hours than you've ever thought you would. But tactically speaking, like where do you see the biggest lift on the ops side with AI, if any?
I would say the biggest lift probably is it'll it'll just replace repeatable processes. So I see it for, income analysis, asset analysis. I mean, anything that underwriting, there's parts of underwriting that I think AI will eventually replace, but that's where I would say the biggest lift is. And I mean, obviously, we're all really concerned about the cost to originate, and it's done nothing but increase over the last few years. So hopefully, adding this technology will help.
Yeah, I got it. And do you see like AI? I mean, how at some point does it like, I don't know, is there like a limit of what it can automate away, or do you think like there's going to be a point where it literally is the Plaza computer talking to, I don't know, Ira's computer, and you guys are doing a trade on the back end and it's doing its own thing?
Controversial question, Marcus, I would say, because I think there's a lot of opinions on both sides of this. I don't think it will ever replace people totally, but I think it will continue to learn over the next, however long, and it will replace some pieces of it, but I don't think it'll ever be. But who knows? Actually, I never thought there'd be a self-driving car. So you know what? I'm going to take it back. So I think it will.
Yeah, those Waymos get out of hand sometimes
Right?
in San Francisco.
Yeah, there you go. Exactly.
James, do you have any thoughts
Hold
on?
on. So
Yeah.
Don, have you ever ridden in one of those?
In a Waymo, I have. Have you?
I have not. How was
Would
it?
you ever? It's all
I
right.
probably would.
Yeah. It's a little weird at first, I would say. But
We
yeah, we
we
have it.
only take Waymos. I think I like it way more than Uber.
Yeah. You don't have to talk to anybody, right? You can link your
Waymo
own
than
music.
Uber.
Yeah.
Waymo than Uber.
Hmm.
All right. Waymo.
Yeah.
Anyway,
Yeah. It's just nice not having to talk to anyone. There's no,
Right.
and it's a nice car too, and it does some pretty cool stuff. I don't know, James, what are your thoughts on AI? Not just on Waymo and self-driving cars, but
Why not
ops.
both? Why not both? We started this call talking about our Uber ratings, so I don't know. Who knows what happens with that? No, I think Dawn made a really critical point, though. I think the thing that I think is really important for people to remember, and certainly this applies to lenders too, is that AI today is the least effective it'll ever be. And what I mean by that is, today as AI solutions get implemented by lenders in things like underwriting or post-closing or really any other piece of the loan manufacturing process, there are certainly inevitably some growing pains. There's the current process a lender has, which, good, bad, or otherwise, is probably getting the job done. And then there's the current state of AI augmented implementations, which for some lenders is probably a major gain, and for others, maybe there's still some wood chop to get there to the kind of ideal goal. And then, of course, there's the future state, like we talked about, with the Plaza computer or whatever it ends up looking like. But I think the thing that's really worth emphasis is that we're just getting started as an industry, and the current state of AI today would run circles around the prior state of, say, 24 months ago. And I certainly don't see that trend changing anytime soon. So in my view, the more experiences and nuances that get encountered by AI-powered technology, the better. So I certainly don't think we've reached anywhere near the top. I think we're just starting to scratch the surface. And, I think certainly lenders are learning that at their own pace.
It's I jokingly made that comment about Plaza Computer talking to the any other lender out there, but there is, and it's hard to tell if it's fake or not, but there is like a video circulating YouTube where it is two laptops talking to each other and then identifying that each is an AI agent and then converting to some crazy, I don't know, Terminator 2 T1000 language that somehow booked a flight for the customer out of anyway. Ira, what are your thoughts on that?
No, I agree with what everyone said. I think for those that have not started to use it, I think there's even just small lifts. obviously there's always privacy concerns. So just putting that aside, I was just reading something for someone that uh, rebutted their appraisal through the AI engine. So they had for whatever they entered into the AI agent, they rebutted the appraisal and they were able to get a higher value on that appraisal. So you talk about things like that. Just even, small things, formulas, if you're struggling to get formulas on Excel. So even if you start, at the lowest level, there's definitely opportunity there to use it. And then again, as Dawn mentioned, those repeat actions is definitely something, whether it be MERS or, purchase advice or, automating the entry of the purchase advice into your LOS, things of that nature, shipping. So there's definitely opportunities there that, you know, without a heavy lift, that you could still, take some time and definitely make use of it.
Yeah, I got it. Thanks, Ira. And then Rob, quick, just overall thought from you. What if you could train a Rob Chrisman AI? Take all your past commentaries, your humor, your knowledge base, and build your own GPT model to write your commentaries for you. What would you? Is that?
I've heard that would take about 8 seconds, right? I'm asked now about my commentary and do I use Chat GPT or AI? And Chat GPT is part of AI, right?
Yeah,
Anyway,
GPT is owned by it's OpenAI's product, and yeah.
okay. Uh, and so I reply, no, I don't use that. But some of the things that I've in talking to people, to Don's point, you're in a meeting or you're hearing from somebody and they said, oh, I threw this out. Uh, excuse me. Um, see, AI makes me allergic. Um, I threw this question to AI and it answered, perplexity. Oh, perplexity this and perplexity that. And, I was able to, it helped me plan a trip to, Hong Kong, complete with, ferry schedules and restaurant reservations that my phone, that could be made and, the ideal flights and so forth. So I don't question the potential. I just don't quite know how I would use it in my simple life. And you could say, well, you could write the commentary in 3 seconds instead, and you don't have to get up at 4 a.m. every day to send it out. But I don't mind. Well, I won't say I don't mind getting up at 4 a.m. because sometimes I do, but I still think that I haven't heard of anybody being replaced by AI per se. I've heard that people's lives are easier because of it, or here's Jasmine talking about it's absolutely incredible. So I think that it's continuing, from what I see, to be a tool that people can use, but not necessarily to replace people. And one meeting I was in, Don, they were talking about, oh, well, remember uh, the farming revolution. It used to be like 20% of people in the United States, their occupations had to do with farming, and now it's down to less than 1%. Well, our unemployment rate hasn't skyrocketed because of that transition to in farming, or the industrial revolution. The productivity, I think, has increased. It would be nice to think that AI will increase productivity and not impact the labor pool per se, at least in mortgage banking, because that's where I know a lot of people. But yeah, it'll be interesting to see how it plays out. But you're right. Every conference you go to, and I've made jokes about this. Every conference you go to, AI or technologies they're on the agenda. And I think that people, at least as best I can tell, need a way to think about AI and how it can help them and how they're using it now, and maybe they don't even know it. So yeah, brave new world.
Yeah, I'll add a quick personal note. I was just out biking in San Francisco the other day, and I was riding with a couple other guys, and one guy was talking about his relationship with his therapist and everything he was talking to his therapist about. I was just kind of listening in, and he ended that talk with he was unsure what to make of it because his therapist was an AI, and I was like, I feel like that could, I don't know, I feel like that could go either way in kind of a spiraling
Wait,
direction. I don't
this
know.
guy's therapist was online AI person,
Yeah,
something?
yeah. Maybe I'll try it for my own personal problems, but maybe that's what I'll follow up with next month on where that led me, what rabbit hole it led me down.
Was there actually like a face
Oh, I
that
don't
was
know. I
on?
didn't. I was just listening. I didn't get into too many details about.
So he's continuing to talk to his therapist because you don't listen to him on these bike rides.
Yeah, yeah.
Okay, got it.
um, Back to what we were talking about earlier with like non-agency and non-QM. So, question for Don: has that changed investor review process given the big shift away? Like someone commented that Jumbo's priced 200 bips better than agency in some scenarios. Are you seeing that on your end with like conditions, investor clearing, and all that?
Um, are you asking if I think investors are using AI for it?
No, it's shifting away from me. I'm talking
Okay.
more about like a shift in like findings and due
Oh.
diligence and just overall like loan file review.
I mean, I think that their loan file review, it's really specific now and definitely more detailed, but I mean, I think in our industry, like we all know this, um, I don't really think it ever changes, to be honest. I think sometimes it's a little, like maybe when the volume increases, it's a little less, detailed and more loans come in and go out. But I don't think that it's changing crazy right now. I mean, I've seen guidelines loosen up on some things that is slightly surprising to me, but I've been in this business for so long. I don't know why anything would surprise me anymore. I don't know what anyone else is seeing, but some some programs that I see out there, I can't even believe we're doing them again, but we are.
I think that's what I would say to your point is I really haven't seen a ton of material changes to most kind of existing investor guidelines that, all of a sudden things are so lax per se, things around the edge, of course, and so on.
Right.
But to your point, what I am seeing more of are broader adoption of a wider range of products, more lenders, even things like more lenders trying to offer down payment assistance programs to find more borrowers, or certainly more of a willingness to dig into the details of some of the non-QM loans and even demystifying what certain non-QM products are and so on. But for me, it's been more. I guess I would agree with you. I'd characterize it more as a willingness to look at different products and innovation on the product side as opposed to kind of within existing frameworks.
Yeah, thanks, James. What about you, Ira?
Yeah, I agree. I think we're seeing more adoption on the loan officer level. So, maybe traditionally where we had some loan officers that, their bread and butter was agency and government business, we're now seeing them open up a little more into the non-QM space. Whether it be agency fallout, whether it be the ever popular DSCR program that we've seen a nice increase in. The other nice thing about non-QM is there's a little more opportunity for exceptions. So, you do have your guidelines that you need to underwrite to, but we found a number of non-QM investors entertaining exceptions, whether it be slightly short on reserves or, maybe an LTV or loan amount exception where as if, back in the agency, it's sort of black and white, right, inside the box. So we've definitely seen an increase as in the last few months. We're about probably a year and a half into banking it. We're comfortable banking it, and we like the product. We're not going crazy with it, as Dawn mentioned. There are some products that you look at and you hesitate a little bit. So obviously you have to have your own, overlays in place and your own tolerances for these products. But it'll be interesting to see how it pans out. As time goes on, these are still fairly new products, right? And we don't have the history of the performance of these products like we have with the agency. So it'll be interesting to see maybe the next downturn in the economy, how these products perform and the performance and see where they end up.
Yeah, I
I
got it.
remember, speaking of performance, I remember when AmeriHome was invented, and as odd as that sounds, and I remember their loan level price adjustment was better than, they were up against Wells Fargo, and the non-owner hit for AmeriHome was like half that of Wells Fargo's. And so I asked Wells Fargo about that, and they said, well, AmeriHome doesn't have trillions of dollars of servicing, and AmeriHome doesn't have the historical hit that Wells Fargo has suffered, in this case, on non-owner product. And so sometimes loan officers or account executives or brokers will shoot me an email and say, how do Fannie Mae and Freddie Mac come up with these loan level price adjustments? And it's nice to say, well, they come up with them because of their historical servicing and the losses that they've suffered on that segment of their business, so they adjust based on that. Other people will say that's not really the case. Fannie Mae and Freddie Mac are trying to uh, make a statement about to lenders and to borrowers, and they're trying to change lender behavior based on loan level price adjustments. So uh, loan level price adjustments are a big deal, and I think that I don't see. There was a note earlier about, will loan level price adjustments change eventually, because if they merge Fannie Mae and Freddie Mac, or if they have another stock offering or whatever it might be. I would say that I would say the answer to that is no, and that's just really a guess. But if I had to guess, Fannie Mae and Freddie Mac will be even more concerned about their bottom line and making money, and loan level price adjustments are one way to do that. And so for them to reduce that is probably not likely, but that's just my, you know, meandering mind. I don't know. Stunned silence.
Sorry,
Sorry.
still muted. Yeah. So I'm reading through the comments here and just kind of the general conversation. When it comes to like the non-QM products, so Don, question for you on this one, like, what's it? Do you have any challenges like training LOs on these new products where even you're a little questionable on, I don't know, we should really be doing this?
So we're a TPO lender, Marcus. So it's brokers mostly
Sorry.
and our AEs, but I would say there's definitely a challenge training salespeople on the products because it's not subprime, right? So it definitely is. There's specific guidelines and I think in rules for it. We all know that, and I think they treat it a little bit like that it is kind of subprime world sometimes, and it's very specific. So DSCR is different, but we have we focus on training a lot. So to hopefully get everyone to understand what it is.
Yeah,
I
got
don't know
it.
what anyone else sees, but for sure it's a different animal than agency.
And then Ira, you said you were just kind of getting into it in the last year and a half. I mean, are you finding any challenges with the wide range of investors and guidelines and products within the DSCR kind of umbrella? I mean,
Yes.
not non-QM umbrella, sorry, not DSCR umbrella, but yeah.
Yeah, especially on the bank side. When we're rolling out a new investor or a new product to our staff, it's not like agency where you just have an overlay for this investor. They require a couple of reserves. These are entirely different products, and each investor might be slightly different. So, it is a little bit of a challenge if we're rolling out, a host of products, and then the LO has to know, okay, this one prices, but if there's something outside the pricing box that the maybe the pricing engine doesn't consider, whether it be short-term versus long-term rental income, or something sort of not normal, you sort of want to be careful to what you're rolling out, because if you give them too much, it just gets way too confusing. So it was mentioned in the chat, we also broker out products, so we always have that option. So we lean on our account executives a little bit more on the broker stuff for the non-QM, but on the bank stuff, it is a little bit of a struggle to train and capture each little small guideline within those product sets.
Yeah. And then this is for like Rob and James. I was talking to the AmeriHome guy, one of the guys yesterday at the conference, and he was saying that they're getting into the or at least they're ramping up their non-QM offering. Do you think since they're owned by, I think it was like Western Alliance Bank, do you think more banks get into this airspace? And does that drive down like rates for that product in a meaningful way since you're moving away from like a traditional fund?
Yeah, I mean, I think as a starting point, yes. I think it's more options, more tools in the toolbox. It comes down to who the buyers are. And yeah, when you look at a bank, for example, if they're looking for yield and they're looking for portfolio loans and they're having harder time sourcing them, for example, the non-QM loans make a lot of sense. And again, I think it's so important for folks that are maybe less familiar that when we talk about non-QM, we're talking about a different way of qualifying a professional investor, for example. We're talking about a different way of lending to a self-employed borrower. Don hit on it earlier, but so often, even today, we still hear things to the effect of like, "Is that the new subprime?" or something to that effect. And it simply isn't the case. If you look at some of the performance history of it all, generally speaking, these are candidly the loans that a lender wants to be making. Again, perhaps a self-employed borrower is a good example here. That's someone that has a really great financial situation, but because of the way they get compensated, because of the way that their tax returns look or otherwise, they're not fitting into the agency's box. So yeah, I think it's the case that like when lenders, and that could be a bank or non-bank, kind of demystify what it is that we're looking at here, they are really attractive investments, especially in the context of comparing to more of a homogeneous or commoditized agency loan.
Yeah, thanks for that, James. With the last 7 minutes here, I thought I'd change gears a little and ask more of just like something that Don and I were talking about, remote work and culture of a company. So at Poly, we're all remote and we have to we do a lot of team bonding events. We obviously all see each other at conferences, but that's only a very small percentage of the company. Don at Plaza is a much larger company. What's that like, and what's your experience been with remote employees?
So we say we're hybrid remote, but we're pretty much almost completely remote 5 years ago when COVID happened, which was a huge cultural shift for us because we had offices all over the country. And it's same as you. We focus on doing team events because you still need in-person communication and, just collaboration. But I would say what it has allowed us to do, though, is hire the best talent. So that really was a huge advantage of remote work. And I'm a huge fan of cameras on all the time because I think you need to see people still, even though, it's a little one-dimensional and it's not perfect. But for sure, conferences and, meeting and doing team events is pretty important. But I don't see us ever going back into the office fully.
Yeah, thanks. Ira, James, I don't know if you guys are remote. Care to share any insights on what work life is like for you guys?
Yeah, maybe I'll start. We're mostly remote. We come into the office. We're a brick and mortar here, First Home. We're a brick and mortar retail lender, so we come into the office for meetings and the like and strategy sessions and so on. And that's some of the things that's very helpful to do in person. But certainly it is an adjustment. I think like speaking for myself, for example, I always grew up on a trading desk. And you can't have a more opposite scenario where you are sitting next to everybody and you overhear everything and you learn a lot that way. And I think for me, and again, I'm perhaps a bit more extreme on this one. That's the thing that I worry gets lost a little bit is some of the training and collaboration capabilities. But at the same time, when you look at, especially in the mortgage business, it is very specialized. And candidly, the mortgage industry demonstrated very clearly that it can perform at a very high level and handle record volume working remote. So I think in the general spirit of things, it's a great thing. There's a time and place to be in the office and collaborate and see each other. And to your point, I certainly agree with cameras on and the like. Having said that, I just sometimes get a little nervous about the lack of in-person collaboration sometimes too, especially for kind of the next generation up.
Before I kick it over to Ira and Rob, I'll do a quick tidbit. So I worked for a company, and I won't identify which one, but they had a strict no camera policy for remote work. And I didn't actually know what any of my coworkers looked like until I came over to Poly and I met them in person at, we're all at different firms at this point, but it was definitely kind of a weird experience. I don't really know the origin story of why I'm guessing something happened that shouldn't have happened on camera, but no one ever gave me the truth on that one. Ira, what are your thoughts on that?
Yeah, the thing with remote work, we have a hybrid policy here. But you also have to hire the right people, right? So just because you have a hybrid or remote workforce doesn't mean everyone just gets to work remote and or hybrid. So, the CEO of our company, Steve Milner, he loves the in-person stuff. He'll fly out to branches, he'll fly out to conferences. So he always loves seeing people. We've been doing roundtables. So for our divisions, we've been meeting with our divisions in person, doing roundtables. We have another one coming up in September, and sort of trying to keep, we have monthly calls, we have weekly calls. So we try as much as we can to keep people engaged and keep that communication going. It's always a challenge, right? But again, the key is having the right people in those positions. Not everyone is fit for remote work, right? You don't want someone sitting there doing the laundry and folding laundry when they're supposed to be working. So, some people have keystroke trackers and, mouse movement trackers.
Oh,
If at that point, if you have that question about someone's productivity, then that's something you have to take a look at. And, people are replaceable. So, that's why I'd say.
so Ira, to that point here, and Don, you may have seen them in the exhibition hall, or uh, or Marcus, you may have seen this company called Rome. And my son Robbie uh, and Jake, who works with us, had a meeting with Rome yesterday, and it's a virtual office replacement, meaning that you could just have on your screen, like everybody's on camera all the time, and you could just have conversations. And I think it's fascinating that technology is trying to replace something that we already have in an in-person work environment. But the owner or the person just person running the display told Robbie and Jake that between 9 and 5, we own you. And that's a sobering thought, to think that you talk about mouse tracking and so forth. The I find it, Robbie and I are here at the Western Secondary together. We find it, or at least I do. I shouldn't speak for Robbie, but I find it very valuable to be in close contact with him, because there is. I mean, I've got 40 flipping years of experience, and it's hard to transfer that information and experience in little bits and pieces when we talk on the phone or when we do a Zoom call together. But when we're walking around and talking to people that I know or that he knows, and then we can say, "Hey, look at that," or "Look at this." I mean, I find that invaluable. And the same, James. I was on a trading desk, Tuttle and Company, as a partner, and just to be, "Hey, who's buying Ginny sixes?" you know, well, this person's doing that. Or, "Oh, did you hear Queen Elizabeth just died?" Or whatever it is. The news flow, I think, is much better in an in-person environment. And yeah, there are advantages to remote office situations, but I'm an in-person kind of guy, for better or for worse. I think there's a lot to be learned by, hey, I was walking down the hall, and there's the underwriter, and I stopped by to get some Halloween candy out of her bowl. And just we started talking about the Jones file, and we figured it out. I think
Yeah,
that's very valuable.
I agree. I'm a mixed bag on this one, just because when I was commuting to work, I'd be in a car for over 2 hours a day. And I was just like, 2 hours a day, you don't get you never get back, and you burn an insane amount of money on fuel and insurance and wear and tear and all that. But at the same time, like, when I was at Opus Advisors, we had like an open floor plan, and you could just listening to other people on the phone, you'd pick up tidbits of like, "Oh, that I never thought of that," or "That you said something wrong on the phone. Let me have a quick talk about it." And you can catch those things much faster. And funny enough, about just like funny pop culture news. First thing this morning at the Western, my coworker's like, "Did you hear that Taylor Swift announced a brand new album this morning at like midnight or something?" I'm like, "No, but awesome." So, all good things. But cool. We're at time, and want to thank everyone, and thank you, Don, for showing up and guest covering for Rob Kessel Day, and hopefully we'll see you again at a future
I love it.
panel.
Thanks, guys.
Yeah.
Appreciate it.
Thanks, guys. Thanks, Polly.
Yeah. Thanks
Thanks.
everyone.
Thank you.